The 5th of April is coming up fast, so make sure you do these things. As a business accountant, my team and I spend all day long helping business owners on their journey. Now, whether you're a business owner or not, there are many things just before the 5th of April you should be reviewing to see if you can make sure you make the most of your allowances. So, as always with these videos, we're not talking about some weird, super aggressive tax saving, tax avoidance scheme or anything like that. We're just talking about what allowances have you got that you could use to make sure you're paying only the right amount of tax. And of course, there are a lot of use it or lose it style allowances that if you don't use before the end of the personal tax year, there's going to be a problem. Now, I'm going to talk mainly about personal tax type stuff, but from a business owner perspective in this. So there'll be things in there that I'll be talking about. So before we get into this, if you like these videos, make sure to click the subscribe button below so you get notified whenever we release more just like it. So let's talk about some of the allowances that are available to you now. And it's a relatively short list actually from an action point of view, but there are some key things to talk about. So the first one would be, if you're a limited company owner, consider whether you can pay any dividends out. Everybody in the UK gets an allowance of £2,000 generally of dividends they can have tax-free in their own hands. So the company would have paid corporation tax on it, but you won't pay any dividend tax if your dividend income is under £2,000. So you want to be reviewing your accounts to see if that's possible. If you've got an accountant, even better, you can speak to them about it. But generally, just start thinking, can I pay this £2,000 dividend? There's actually another video on the channel that talks particularly about this issue, so make sure you've considered that as a possible. And also, if you're sharing finances with a significant other in the house, if they're on the company, can they do the same? It's those kind of things. So check your dividends, number one. There's some more boring things I always think, but it's like ISAs. So people get excited about ISAs. If you've not heard of those, they're kind of like imagine they're sort of a tax-free kind of bucket where you can stick money and it can earn interest without outside of tax. That sounds pretty exciting, except for most individuals in the UK are going to have between £500 and £1,000 of interest they can earn without paying any tax anyway. And generally, the ISA rates are lower than a normal interest-bearing account. So I think you've got to review whether actually the ISA is an overall better thing for you. Us mere accountants can't give financial advice in that sense, but go and check it out. But you can do the maths easily enough, I'm sure, and then have a look. So, but if you are up against it with that interest allowance, you can invest up to £20,000 in an ISA this particular tax year to kind of wrap that money up there. So that is definitely worth consideration. If you've got kids, so if you've got child benefit, have a look at what's going on with your child benefit. If either one of you in that household is earning over £50,000, there's a chance, well, there's not really a chance, you're gonna have to pay back some of this child benefit. It's a really weird one, but basically, quite often the scenario will be stereotypically that one of you is the primary caregiver and not earning that much money, if any, and then the other one's earning, say, £60,000, and the child benefit's being received by the lower earner, but what happens is the higher earner then has to pay it all back on their tax return. So bear that in mind, and I think you should then be assessing actually for next year, and there's nothing you can do about it now, other than knowing, oops, I might have to pay some of my child benefit or all of my child benefit back, but you want to consider in a future year, is it worth having? It's probably another whole video, but in a lot of cases, people will still want to do it because it's cash flow. They get to enjoy the money and then hand it back a lot later, so that's a possibility, but do review your child benefit situation. And then there's a slightly less exciting one again called marriage allowance, and it allows you to transfer some of your, if you're married, it allows you to transfer some of your personal allowance. So everybody gets like £12,500, or into the new year, it's just slightly more than that. Tax-free, you can earn up to that without paying any tax, and it's possible to shift some of your allowances across to the other person, but it's not possible where one of you pays the higher rate of tax. So let's just say when you're earning over £50,000, and again, that's limits going up slightly in the next tax year, you can't do it, but generally it's quite useful if, say, one of you is not earning and the other one or certainly not using all of their allowances, and the other half is, and they're not paying over 50 grand, getting paid over 50 grand. And it will save you up to around £230 plus in a tax year. But it's a bit of a weird allowance that you can only transfer sort of all or nothing of this particular amount they give you. So you do need to consider whether that's a good idea. If you're only just using under your allowances here, it's not necessarily a good idea to transfer this whole chunk of allowances over here, but that's probably outside the scope of this video. But know that it's possible. It's very easy to apply online. So if one of you clearly is not earning anywhere near 12,500 and the other one's earning under 50,000, that's a very big possibility for you. So check that one out, marriage allowance. In the other unexciting camp, but worth talking about, there's two really. One is pensions, and the other one is gift aid. Now, if you're a higher rate taxpayer, so you're earning over 50,000, then this is really for you. And that's looking at, are you making any charitable donations personally to charities, registered charities? Normally you've been asked to fill out a gift aid declaration. If you've done that, make sure you claim that on your tax return, because you will actually get some tax relief on those particular claims. If you're a basic rate taxpayer, i.e. you're earning under 50k, it's not really very exciting from that point of view, but there is a box still to put it on the tax return if you do one of those at that point. But yeah, definitely check that out if you're a higher rate taxpayer. And then it's the same with pension contributions. How a lot of pensions work is you get a top up at the pot. So you contribute personally, and then at this end, the tax man puts in 20% into your pot. Not always, but quite often. And with the right pension scheme, if you're making those contributions and you're paying 40% tax in your job, obviously in theory, you should be able to top that pot up with this extra 20% tax that's not accounted for. So you do that. The way they do that is they don't actually top the pot up, they give you the tax back. So they give you actual tax relief on your earnings. So if you were to put that into your tax return, the likelihood is if you did that in the first year, you might well get a tax refund directly to you rather than your pension pot. So I think the key takeaway there is if you're a higher rate taxpayer and you're making personal pension contributions, then it's highly likely that you should be filling that in on your tax return, and it could be a good all-round story for you. I know we did a client recently that ended up with a £7,000 rebate off this because they just didn't realise that was a thing. So definitely keep that opportunity out. And if you've got any questions around that, speak to your pension provider, speak to any independent financial advisor that's around, and just check on the type of scheme you have and whether it's something you should be doing. But there's a cap of contributions you can do of up to £40,000 each tax year that you can put into a pension and gain this kind of relief. So there's other rules around that, but that's just the top level stuff. So check that out if that is you. Now, if you're into the big stuff, so you're into say property or you're a landlord, there's a couple of things here. If you're a landlord, consider doing any repairs and renewals you've got to do before the 5th of April. I always think the worst time to repair a property is somewhere in early April, just after the tax year, because if you did it just before, you're impacting your next tax bill. You're reducing that tax bill. So you never hear me telling you go out and spend money to save tax, because it's a stupid idea. At the end of the day, most of the time, let's just keep the tax rates easy. If you spent 10 grand, you might save 2. So unless you needed to spend the 10 grand, there's not a lot of point. So it's a bit like this. If you need to do the repairs and you know you're going to need to do it the next few months at the other side of April, then consider bringing it forward and impacting your tax bill. Now, if you're thinking of getting rid of any property or shares or Bitcoin or all these other things that you might be involved in, you get a separate annual allowance called a capital gains allowance each year. And it moves each year, but it's not far off what the personal allowance is now at around £12,000 a year. And what happened, and again, it moves each year, but that is a separate allowance. So if you sell some Bitcoin and make a 10 grand profit, you're not going to pay any capital gains tax, as it's known, on that, because you've got this allowance. So the worst thing to do is if you're going to sell and make a profit of say 20k, if you'd done 10k profits worth before April and the other 10 after, you're using your 12 odd grand allowance in one year and your 12 odd grand allowance in the other year, and you're not paying any tax. If you sold it all in one tax year for 20 grand profit, you're going to pay tax on like the roughly 8 grand profit that's not covered by the allowance. So consider, if you are going to sell big chunks for profit, maybe splitting them over tax years if you can. Obviously with the property, you can't really split that into 2 chunks, but if you've got a couple of properties you're selling off because you want to get out of the market or something, selling it across the tax years is also quite useful for you. Now, while we're on the topic of big stuff, if you're a business owner, quite often, going back to what I said a minute ago, you're not looking to just randomly spend money to save tax, but it's the same deal. If your accounting year, so let's say you're a sole trader, and quite often you as a sole trader, your accounting year will run with the tax year. So you cut off on the 5th of April. If that's you, consider the exact same thing. Am I looking to invest in any, they call it like plant and machinery, but am I looking to invest in new computers, tools, vans, these kind of things? If you are, there's an amazing allowances for buying those currently. And of course, what will happen then is, let's say at the moment you bought a 5 grand bit of equipment, or it's camera equipment or a drone, and you're into drone photography. That's quite popular at the moment. So you buy those kind of things, you get to knock the whole of your 5 grand off of your profits before you get taxed in 1 year, which is pretty impressive. So, and it will have quite a decent effect on your tax bill. So do consider that. Same deal. If you're going to buy it in the next few months, consider bringing that forward. It doesn't work on things like stock and things that you wouldn't sell at a later date in most cases. But just think about plant. I want to say plant and machinery. That's the technical term. But the big stuff, your computers, your laptops, all that kind of stuff that you might refresh. Consider doing that before the 5th of April. However, I would always say that nearly every year, but in this sense, there is one caveat to this, and that is if you're a company and you're thinking of doing this, From the 1st of April, there's a new super deduction that was announced in the budget that instead of giving you that 100% tax relief I just mentioned about, where you get to knock the whole of the cost off against your tax bill, they'll actually let you knock off the whole cost and another 30% off your profits of the stuff that you buy after April. Currently, at the time of recording, this only applies to limited companies. So it's a same sort of deal. You know, if your company year runs around with the tax year, now's a good time to be thinking about this. However, if you wanted to maximise the actual tax back, you would probably wait, or tax relief, you would probably wait until the 1st of April. The downside to that is that it won't affect your next tax bill. If you imagine the line's drawn at the 5th of April, more likely with a limited company, it's going to be drawn at the 31st of March if that's your year end. Your next tax bill is impacted by what you're buying now. If you wait to the 1st of April, you won't see the actual benefit until your next tax bill after that. It's quite a way away. So it's that toss up between, do you want to save some money that you might have to part with soon, or do you want to maximise the total amount that you're saving? Hopefully I've explained that easy enough for you. So that's the big stuff. While we're on the subject of limited companies, let's talk briefly about salary. So just review your salary. It's very normal in the UK to have a very low salary for, let's just say, somewhere between 8.5 grand and 12.5 grand roughly for you as a director of a limited company, and then you might take the rest of your profits in dividends, so that overall that ends up being the cheaper option of how to take your money from the company generally. Now, in this particular case, especially with furlough being in play and all these other things that might have happened during this year, it's even more important to look back at the year and say, am I happy with that I've used my allowances? If you've only got 5 grand on payroll, well, you're going to lose out on a state pension qualifying year, because you want to be probably 6.5, just say roughly to be safe, to make sure that you've got your state pension year that's important to your pension pot later on, and you still won't pay any national insurance on that in that level, so that's really, really good. Or if you're, I don't know, let's say you've done 7 grand, but actually why have you not done 8.5, 9.5, 12.5, used some more of these other limits? So do have a look and just think, have I maximised it? And it is so dependent on your situation, it's hard to say in a video what the best level for you is, but I think if you've paid yourself less than about 8.5 grand, you should be thinking about, is there a possibility to maximise that and make an adjustment to like this month's March payment, or pay yourself a bonus or something like that. So just have a look at that, and then consider when you move into next year, what's the best thing for me right now? I'm sure we'll do some video talking about potentially what the best thing is moving into the next year, but for now, yeah, that should be a consideration for you. And that are the main action points for you now. I think there's a ton of stuff there to get your teeth into, whatever your situation. Have a look at them, see if you can use any of those allowances, and you're going to be super tax efficient. Please do share this with anybody that you feel needs to know this information, and I'll see you on the next one.